Hi, Zaven Boyrazian. He's our lead analyst. And so my name is Imran and this is Zaven. We both co-founded the Money Cog, which you see on this YouTube channel, but we've also got a website which we write stock ideas, which the idea is to help investors like you come up with ideas which could give you between 10x to 100x returns. Or that's what we hope that you're going to get by reading our content. So we thought, first time we're doing a video, we thought why not talk every week. We release a new report, an insightful report on an analysis on the company that we believe meets these requirements of a potentially 10x or 100x return company. And we thought, why not do a video to talk about the company, how it makes money, the fundamentals, and what we think of the on the valuation. And if you want to read the full report, you can look at the description. You can get a link to the video, the link to the report in the description below. So first off, welcome as the first episode, Zaven. How are you today?
I'm doing all right. Thank you for having me.
Yeah, no problem. So I guess the first company we're going to look at is, well, not the first company we're researching, but the first company we're going to do a video on is probably a company not many people have heard of, which is called Judges Scientific. So maybe if you want to give us a brief background on what the company is, where is it located, and even where can you trade or buy it if people are interested in finding out more.
So Judges Scientific, it behaves like a holdings company, but it's specifically a designer and manufacturer of scientific instrument. And the way it works is the company itself, it invests and buys a stake into all these smaller subsidiaries. I think at the moment it has around 30 businesses under its portfolio.
So you mentioned, you mentioned a holding company. What do you mean by that? It behaves like a holding company.
So all that is essentially a larger company that buys an equity stake into smaller businesses. And then those businesses tend to run independently, but they're all linked by the same sort of overall management team.
So the holding company doesn't actually make anything revenue or
no,
has
it's like
an umbrella.
An umbrella. It's like an umbrella.
Yeah. Okay. Cool. Just thinking, just explain to those who might not understand what that means.
And of all the different companies it has in its portfolio, there's quite a lot of variation. They're all focused around creating some form of scientific instrument. So, for example, one of its subsidiaries creates gas purifiers used during metal analysis. And then you have others which are building temperature control systems that are even being used at the CERN super collider right now.
Oh, wow.
There's like 30 of these different, they all do different things. They also tap into the battery testing as well as microscopy for cancer research. It's very vast and broad.
So so is it a company which has all sorts of sectors, or is it just one? I mean, are we saying it's got a very diversified pool of businesses that it has in its portfolio? Okay.
It targets all sorts of industries. You've got from aerospace, the automotive, pharmaceutical, even manufacturing.
Okay.
So
maybe a bit more about how specifically does it make its money? I mean, people can look at the revenue breakdowns in the long piece note in the article, in the sort of report you can find in the description. But from your perspective, what's the driving force behind the revenue? Because we sort of saw it was fairly, one company does 5% revenue contribution and others 10, or do you feel it's actually just a diversified play? From an investment perspective?
Essentially, each of the businesses fundamentally work in the same way. They design a piece of equipment, they manufacture it, they sell it, and then they're constantly either selling to existing clients who need upgrades, or they're looking for new clients at the same time. That core principle doesn't really change between each of the different businesses. In terms of revenue contribution, it sort of varies depending on maturity. Some of these businesses are already classified as industry leaders for their very specific niches. But others are either very young, they're brand new, or they simply haven't created a product that's ready to go on market yet. And there's a lot of that. I think at the moment, only around 15 of Judges Scientific companies actually generate revenue. So that's about half of them. And the other half, they're still early stage. We'll see what happens in the future. Sort of.
I guess there's more details of that in the note.
We break down all the businesses in terms of what they do in the report for premium members. And then for the ones which don't generate revenue yet, we sort of have a quick glance at it, but don't go into too much detail.
As for those
when that time comes, we can obviously update the notes. And
Okay, and just for those who don't know, the premium, we're offering free. It's free membership for premium for one piece of one company at a time, isn't it? Per month, isn't it?
Yeah,
Is that
so there are 2 free reports at any one time. There's a new one published every month for free. And obviously anyone who signs up has access to the whole platform for 30 days as a sort of try it out, see what it can do for you sort of thing.
And I guess another question is, whilst past performance is an indication of future performance, how's the stock price?
So you mean it's not an indicator?
Yeah, so past performance is not an indicator of future performance. But just so people know, what's the stock done, just as a perspective of
okay. So since the start of this year, it's not done great. It's down by around 20%. But as we all know, the market is in a bit of a little bit of a storm at the moment with all sorts of stuff going on. You've got inflation, you've got interest rates, and now you have a growing political situation in Eastern Europe. It's not great. But if we zoom out and go to a 5-year perspective, the stock is actually up over 350%. And if you go out further, over the last 10 years, it's actually a 10-bagger. So you could have made a £1,000 investment 10 years ago would now be worth over 10 grand, which is quite extraordinary.
No, that's not bad. I mean, we can talk a bit about what we think the future is in terms of opportunity and valuations a bit later on. But yeah, that sounds quite exciting, a good story. I guess the next question is, you mentioned, okay, it's got all these businesses that it has as a holding company. So you can imagine any holding company, one way in which it can grow is the cash flow that generates from all the operating businesses. It can use that to acquire other businesses, or it can go and raise debt and then buy those businesses through debt. So maybe just talk a bit about what is the strategy for Judges Scientific and the way in which they approach building and scaling their businesses and adding new businesses into their portfolio.
Okay, so rather than creating businesses from scratch and building their way up, Judges prefers to take an acquisitive route. And like I said, it raises money, it raises capital, typically using debt. At the moment, it has around £24 million on its balance sheet, which is slightly lower than the end of 2020, but it's still quite high on a historical basis. And obviously, it's using that capital, it's buying into businesses which it believes are valuable, they can add value across the future. And then as those businesses mature under the ecosystem of Judges Scientific, then the long-term goal obviously is to create enough value to pay back the debt as well as generate surplus cash flow.
Okay. And a bit more about, so you mentioned a bit, and I've had a read of the actual report, a bit about something called goodwill. And for those who don't know, goodwill on the balance sheet is when you overpay above book value for a company, and that's treated as goodwill, and that over time gets impaired. And we can talk about that in another video, how that's treated, but essentially it's something that has no value, right?
Yeah, and it's intangible.
It
exists to make sure the balance sheet balances.
Yeah, but one thing you mentioned in this company is that actually, when you take that into consideration, is this company actually a good company to invest in? And I don't know if you want to share something that you did, quite an analytical piece that you did in the insights report that people can have a quick look at, a sneak preview now, but they can read the full report in the link below.
Okay, I'll open this up. There we go. Right, so what we're looking at here is a chart that's looking at something called the return on invested capital.
Yeah. And
this is a metric to judge how much value is created from each pound that is invested by the company. So a value of 10% would mean that for every pound they spent, they're getting £1.10 back. That's good, obviously. Now, what you can do is when you're calculating return on invested capital, you can also include goodwill into the formula, and that will always bring the value down. And what that's showing you is the company's ability to generate value over and beyond what it paid for as the premium for its acquisitions. Yeah. So what this chart is demonstrating, taken from the premium report, we can see the return on invested capital climbing steadily high, reaching as high as 47% in 2019, which is extraordinary, by the way. Yeah. I think the average for the market sits anywhere between 8 and 12%. So seeing a value of 47% is really, really something.
What's the formula? Just so people know, the return on invested capital, so it's your net income divided by what you would consider sort of capital. It's the debt and the equity, isn't it?
So return on invested capital, there's various ways of calculating it, but the general gist is you take your operating income of a business and you divide that by the total amount of invested capital.
Yeah.
Now, when we're doing it with the adjustment for goodwill, we also add the goodwill to the invested capital in that equation, and that will naturally bring the result down.
And that makes sense for those who's listening, because you're essentially, goodwill is what you've overpaid for something. So you've invested too much into something. So you've got to take that into account when you're looking at these the return on invested capital. Okay, I mean, that sounds pretty good, but you can see that, I mean, but it is going down, or is that just because of it's a half a year, or what's the reason?
Okay, so we can see at the end of this chart, the return on invested capital for both goodwill and without, that dropped down, and that's because of 2020. And it's almost as if a pandemic came out around that time. So seeing that decline, that's not too concerning. When the next set of results come out, we can see if that starts to recover. Based on initial insights and guidance managers provided, margins are already on the rise, which is a strong indicator that return on invested capital is doing the same, but we will see. But what I wanted to demonstrate here is, if we ignore 2020 for a moment and just look at 2016 to 2019, obviously return on invested capital is going up, but the margin difference between return on invested capital with and without goodwill is getting wider. And that can be an indicator that management is either being too aggressive in its acquisition strategy, or it's overpaying for businesses. So it's something to keep an eye on.
Okay, I mean, that's worth thinking. I mean, you did mention though earlier on that some businesses aren't producing even revenue, so it might be one of there is, I think it might be a delay in seeing that. So something just to keep an eye on. Okay, I mean, you mentioned something about management just now, about because this is very much driven by management, right? And acquisition strategies and management. So for us, a key thing always is, and especially when you're looking at these stocks that can generate sort of 10 to 100x returns, is you want management who've got equity in the business. You want management, you sometimes like managers who founded the company because they're the visionary behind it. You know, you look at Tesla, you look at sort of Elon Musk, for example, you know, you look at the time Microsoft with Bill Gates, but then now Microsoft, you know, with the new CEO is doing well, but management is always a key management is a key aspect that you probably want to look at an investment. So what's the management team like at Judges Scientific? What's the history? Is there anything that we should be concerned about?
So while there are some what appears to be a talented management team at Judges Scientific, the main show seems to be run by David Securial, who I may be butchering the pronunciation there. And he's the founder and the CEO. The company was founded back in 2002, so it was a long time ago now.
Wow.
And before he started this business, he was actually a specialist in turning businesses around. He would essentially go in to a struggling business and find the problems and fix it. And it's something he seems to be doing rather well with Judges Scientific when it comes to targeting their acquisitions. We've already seen some of the stock price growth he's achieved, so clearly something's going right. Now, that itself does create a bit of an issue, though, because he's getting a bit old, to put it politely. He's about 71 years old now, which is usually around the time founders tend to step back and, you know, start planning for retirement. So the question then becomes, will his successor be able to fill his shoes? And that's something we have yet to see.
Okay, I mean, that is a key risk to think about, something we probably should be concerned about. So when you put that all into perspective, what do you see are the sort of concerns in this? Well, actually, before we go into the concerns, what are the competitive advantages that you're seeing right now of Judges Scientific versus what its rivals might be doing, what the market landscape is, and does it have many rivals?
Okay, so the scientific instrument space is highly fragmented because each sort of aspect of the scientific process is so specialized. Finding a business that does a bit of everything is quite rare. Even in the case of Judges Scientific, it's a holdings company, which means all its businesses, they're all targeting on different aspects. There is some overlap, but not much. But as a result of being such a specialized field, it creates high barrier to entry. So it's very difficult for a young startup to come in and say, we've created this brand new piece of technology, everyone should start using us instead. Even if it's true, you've got to convince the world experts and engineering firms and scientists that is actually the case. And bearing in mind that this equipment usually costs, and you know, you get the low level stuff, but you also have things that go up into the millions of dollars. So Judges Scientific has that advantage because it's already established. We already mentioned that some of its companies are considered global leaders for very specific purposes. And that already commands pricing power. If you look at their operating margins, currently they're around 14%, which is slightly lower than last year. But again, we're in the middle of a pandemic. But if you compare it to the industry, the average has always hovered around 8%. So clearly they're demonstrating some form of pricing power there.
Yeah, I mean, that sounds pretty good. I mean, pricing power that you've mentioned, and you mentioned that there's unlikely kind of a disruptor. So what are the concerns that you might feel that you want to?
Beyond the key person risk of the CEO potentially leaving in the next couple of years, he may not, we'll see. I think the biggest issue or concern I have surrounds its actual customers. A lot of these are sort of research labs scattered across the world, like CERN, for example. And you obviously also have customers from the private sector. But for those that aren't, their budgets are usually dependent on government grants and subsidies and whatnot. And that essentially means that when the economies do badly, the spending goes down. We already saw that in 2020, even though like the demand for scientific instruments didn't go anywhere, the budgets for a lot of these sort of scientific communities went down because government spending was obviously focused on tackling the pandemic rather than scientific research. And that's a risk that's going to remain throughout the entire history of this company, I think.
Yeah, makes sense. And we didn't talk about it yet, but it's the main piece, probably one of the main pieces of investing is valuation, which is, it might be a great business, but is it expensive? Is it cheap? Is it something that you'd want to have in your portfolio? So based on your approach to valuation, what is the valuation of this company? Do you think it's a good investment at current prices?
So you don't really need to look very deep to figure out this is not a cheap stock. I mean, just if you want to take a multiples approach, the PE ratio, it's currently around 43 today. For reference, the market average is about 15, historically, that is. So yeah, not a cheap stock. And when we did our discounted cash flow model for the premium members, we came out with a valuation that suggested the stock was overpriced at the time we looked at it. And it might still be today. But it's worth mentioning that there are numerous reports about the market opportunity in which it operates. For example, Allied Market Research, investment research group, they recently released a report that predicted the global market size for scientific instruments is going to reach around 36 billion pounds. Maybe, I think it's around 36.6 billion.
What is it today?
Today, I think it's about half of that. So there's plenty of growth available.
That's the point. I mean, I remember reading, and actually, when we talk about PE ratios, and what people need to understand is, whilst if you look at it alone, it might be misleading. So, well, something is above, the PE ratio of the market at 15, it's expensive. But you've got to look at, well, what's the potential and the total addressable market that it's looking to grow in? Because it might be, and that's where management comes in. That's where you look at the strategy and say, what are they doing now that's going to be different? Are they going into a new potential sector with a new revenue stream? Not a sector, but a new area that might generate more revenue streams. I mean, you think about Apple and AirPods. Suddenly, you've just created a whole new segment, a revenue segment line, and great amount of revenue that's just being generated from that. And that alone would be a business in itself. And it's like, well, okay, well then a 40 times P ratio might be too cheap. It should be at 100 times. If we look back 5 years from now, it might be, well, actually, that was quite cheap, because it's all based on past earnings or forward 1 year earnings, when actually you've got to think about earnings potential. And I think that's something that today investors need to think about, was what is that earnings potential? And we talk about, and that's why I think both of us tend to focus on in the Money Cog, and it is much more about the qualitative nature, it's qualitative research versus quantitative. Because I think there's so much information out there today on all sorts of statistics, and you can gather all data from, free now from Yahoo Finance about balance sheets and financial ratios. But actually, 90% of companies on the S&P 500 have their assets are intangible. 90%. That's a lot more than it was before. So it's how do you value these companies? Sometimes price earning ratios or price book maybe not the right way. So you've got to have a more qualitative approach. And something we look at within our COG score methodology, which maybe, since you're the mastermind behind that, explain to people a bit more about it. And we don't want to give away what the COG score for this company is. We think you can read the full report in the description below and see that score. But maybe you can give a quick synopsis of what it's about.
So the COG score is something we created to essentially judge the quality of a business based both on the qualitative as well as the quantitative side. And what it's essentially doing is looking at the business model. It's looking at the management team, the culture, the financials, the market opportunity. And it's compiling all of that into a simple score between 0 and 100. Obviously, the higher score, the better, because it essentially means if you have a score of 100, then you're apparently the most perfect business that's ever created. So far, we've never found a company that met that criteria. I don't think we ever will. Every business has its flaws, but
if we do, it might just be a scam.
Well, yeah, but there are plenty of companies that receive a lot of media headlines, and when we did our analysis of it, they were fine, but there's a lot of overhype out there. So what you can end up finding is these businesses which are perceived to be fantastic in the eyes of many retail investors, in reality are pretty average. And the COG score is an excellent way of spotting that, we found.
And we've got research and within our own portfolios which shows that it's been a good way to make investments in the past. We'll leave it at that for this investment. So hopefully you guys, or whoever's made it to this end, found it quite interesting to watch and learn, well, to watch this video a bit about one of the companies we look at. Next week, we'll do another one on Dutch Bros, which is a company which I'll be looking at, which is a coffee chain in the US. So we'll have a discussion on that. But we're aiming to do one a week and one insightful report, and also giving some nuggets of how we look at investments. So stay tuned for next week's episode. Thank you, Zaven.
Thank you very much.